Hey everyone, welcome to the Kruze Consulting free online course helping you put together your venture capital pitch deck. Today we'll be discussing the financial projections and financial projection slide. There will be a separate recording where we actually dive into the financial model that we have presented or pasted into this deck. Again, this entire course is available at kruzeconsulting.com/pitch-deck. It's KRUZE consulting.com. As always, I'm joined by Haya, who's a leading pitch deck consultant, TechCrunch reporter, startup founder, and former venture capitalist. I am Healy Jones. I am a former venture capitalist, and I lead the financial planning and analysis team here at Kruze. So it is my day job to help companies put together projections for venture capitalists. Haya, how are you today?
I'm doing great. How are you?
It's a beautiful day, a little chilly, but I'm doing great. Thanks for your time.
Yeah, of course. Good to be here.
Great. So let's talk a little bit about what we're gonna discuss here. So we're gonna discuss the financial projection slide. This slide is sometimes in the appendix and is sometimes in the meat of the slide. What is this slide for?
So it's basically to help a VC gauge what your company looks like in numbers, right? So in my mind, we already in a previous episode we talked about the operations plan, and that is kind of covers the amount of space you can see. That is like your immediate plan for what's coming up next. The financial plan kind of goes a little bit further into the future, and it shows a couple of things. Most importantly, it shows whether or not your company is actually VC scale. Like, how big is this thing going to get if your plan works out the way you're hoping?
Two things. We've already released the operating slide free course. Please reference that, and it actually ties in very tightly with the projections. So these two slides and the data should work together. So you should also watch that if you're watching this one. And then secondly, yes, I cannot tell you how many times I see a company that has 5 million in revenue in 5 years, and that's as big as they're going to get, and they need 20 million bucks to get there. But that is not the type of a business that a VC wants to work with. VCs need businesses that are get big. So you're trying to help the venture capitalists understand you're talking the same language. There's going to be a big opportunity. You're shooting for the moon.
Yeah. For sure. And I think the cool thing about telling that story with numbers rather than with hopes, dreams, and hand waving is that this is your common language, right? The VCs spend day in, day out working with basically figuring out how they're going to take their LPs' money and multiply it. And to do that, they have some very complex models to help them figure out what their investment thesis is, what they need from a startup, what they need from each individual investment. And if that investment thesis very neatly overlays onto your financial plan, that is a massive plus.
Sure, I totally agree with you. Although I would slightly dispute that a lot of VCs have complicated financial models. Having been a VC, some of them are pretty darn simple. But regardless,
I mean, you can write on a post-it, maybe. No, yeah. I mean, in my experience, at least they have some sort of vision for what they need from the startups.
That's correct. That's right. You're fitting into a portfolio, and the basic reality is that the VC is looking at almost every investment as one that they hope gets to be big enough to return the whole fund. So you got to show big growth. That's just the game in Silicon Valley. You should be prepared for it. The other thing the venture capitalist is looking at when they're looking at your 3-5-year projections is where you'll be along the journey and what you're going to look like at the different fundraisers, because they're going to want to make sure that you're attractive enough whenever you're running out of money or next fundraising to have that money come in, because they don't want to be your only sugar daddy. The way that Silicon Valley works is, in general, a particular company leads the Series A and another venture capital firm leads the Series B and somebody else leads the Series C. So they're always looking for businesses that will not have problems raising that next round of funding. In addition to that, they're also checking to see how much money the company is going to need over its lifetime, because certain the VCs invest in their pro rata rights generally for companies that they like, which means that each round they're expected to put in some more money to defend their ownership, it's called, to more or less keep their ownership percentage the same. And they need to know how much that's going to be. Can they continue to hang with your business as it needs increasing amounts of capital? They need, then from a portfolio construction standpoint, inside the venture firm, for every dollar they commit, somewhere between 100% more to maybe 50% more they would reserve for that portfolio company along the journey. And that means that even though maybe they've made 10 investments out of a fund, and that's how many investments they're going to make, they have just the same amount of capital as reserved. Like half the fund is deployed, half the fund is sitting in reserve to support companies. So they need to make sure that they can support you along the journey. So really important thing to remember about venture capitalists is that they don't just make one investment and are done. For the good companies, they'll continue to invest along the journey.
Yeah. And inversely, if an investor invested in an earlier round and doesn't invest this round, that is typically a pretty scary thing for the startup and for other investors.
In general, that's not a good signal.
Yeah, no, it's really bad news because this company has been on your board. They know a lot about the inside of your company, and if they choose not to invest, that's that's often a signal. Now, that isn't true for all venture firms, and it isn't really that relevant to this particular conversation, I suppose. But it's worth keeping your VCs close, because it might send a signal.
Right. All right. So of the four things this slide is for, we've just discussed them. So the first one is, are you getting big enough? The secondly is sort of, what do you look like at your next fundraises? Are you going to be able to do it? The third is, how much capital are you going to need so the VC can construct their reserve strategy in their portfolio? And then the fourth one, and this is probably what most founders just instinctively think about when they think about this slide, is, do you have a good grasp of the financial implications of your business model and your business strategy? Right. So this is a numerical representation of the strategy that you're talking about in your hopes and dreams. So you better tightly align, the numbers better tightly align with that vision that you're espousing as you're walking through your pitch deck.
Yeah. And there's an interesting piece to that too. When you build your financial model and you realize, wait a minute, these numbers don't fully back up the story I'm telling, that means that either the story is wrong or the numbers are wrong. And it's really important to be honest with yourself about what's going on here. Like, if you think you can build a company with 12 developers and your plan shows that you can't afford 12 developers, then you got to raise more money, or you got to find cheaper developers, or you got to do it some different way. Be super careful, because here you're showing that you have a plan and that the plan should actually work out financially as well.
Right. And not to get into the common mistakes that I see, but another common mistake that I see is that you're selling your product, it's an enterprise sale, and there are 500 companies in the world that could potentially purchase your product, right? And they're going to pay $1 million a year, right? So that's $500 million in revenue a year, and you are showing $1 billion in revenue. So what's going on? Like, who else are you selling to? Because if your pitch is that there's 500 potential clients and they're going to pay you $1 million a year, how did you get to $1 billion in revenue? Right. So just keep that in mind. Like, how big is your market? How big can you get? That's got to somehow interact with your out year revenue numbers.
Yep.
All right. So who needs to have this slide? And again, this is what I do day in and day out. I think this is incredibly important. I think I would both agree that a seed stage company doesn't necessarily need a pretty incredible detail on this slide. I think the main thing there is, how big are you getting and how much capital you're going to need on your journey, right? So in particular, if you're talking to a professional seed investor who expects to get pro rata rights and expects to invest along all of your rounds, it could be pretty easy. Like, hey, listen, we're going to get to 100 million in revenue, and we're probably going to have, series A, B, and C, and it's going to be $50 million we have to raise in our entire team. I think that probably gets you far enough at a seed stage.
Yeah.
Now, where I think companies really need this is the Series B, Series C, and increasingly the Series A, as there are a lot of really sophisticated later stage financial investors who are really changing the dynamics in the later stage funding market right now. They're making capital really easy. They're making very fast decisions. They're disrupting the venture capital market, and VCs like to invest in companies that disrupt markets, and then when it happens to them, they get all upset. But it's happening, right?
Yeah.
And these late stage investors are financial oriented. And so having this slide, I think, sets the table for that financial diligence discussion. And it also helps that later stage investor realize, like, yes, these folks have a financial model. It's probably an Excel file. They can send it to me when this conversation is done. And I can do that fast turnaround time. I can drop that into my actual sophisticated projections and portfolio model and come back with them, yes, no, and how much if yes.
Yeah. I think it's also worth spelling out explicitly why that works at the later stage and not at the earlier stage. At the later stage, you're talking about growth capital, right? You have a functioning business model. You know that if you pour $10 in the top, $11 fall at the bottom. And so really it becomes a game of like, how fast and how quickly can we grow our market share and our lifetime value for the customers, whatever the business model is, right? And so if you have a functioning business already that you're just looking to grow or go into new markets or whatever, it becomes actually relatively straightforward to analyze that, because you can look at the numbers and go, yeah, I believe this. This is a believable founder with a believable product in a believable market. And this model makes sense to me. Cool. Let's write a $20 million check. That isn't as easy as the earlier stages, because you haven't really figured it out yet. And it's much, much, much higher risk. Because of the higher risk, the financial model just isn't as believable, right? Because you don't really know what the mechanics are and what the dynamics are in your market yet, or for your acquisition and all that kind of stuff. So I think that is, I know I'm probably saying the most obvious thing ever, but it's worth keeping in mind that that is why it's so much easier, in air quotes, at the later stages to invest off a spreadsheet than just off the hopes and dreams.
Completely, 100%. I agree with you.
Yep.
Totally true. Yes, exactly. And so we're not going to walk in this call through how to build a financial model, but we will do a course just on the spreadsheet. You should also reference the operating model that course that we walk through, because we do dive into in somewhat detail what is being looked for on the operating side, and there's some overlap here. But just at a very high level, if you're going to, when you're building your model, the first thing to remember in Silicon Valley is, the numbers are pretty crazy. People are looking for businesses that are going to grow like crazy. So it's not weird that you're going to have extreme financial projections. Like, you should show some pretty serious growth if you're the type of a business that's going to generate revenue. Now, if you're a biotech company, that's different. You're not necessarily expecting to generate revenue in the foreseeable future. So there's less pressure on that. But if you are a software as a service company, a crypto company, e-commerce company, you're going to want to show some pretty aggressive growth, because that's what the investors are expecting that your business is going to do. And if you don't have faith in your ability to do that, then it may not be time for you to go and raise a Series A. You might want to raise a seed extension and figure out what parts of answer those questions that you don't know yet. Right?
Yeah, and the place that typically comes up is in regulated markets, right? If you're looking to open basically a new type of bank, or if you're looking to launch something that needs FDA or FCC approval, if you need something that has some sort of government oversight or certification or something like that, it means that your model doesn't start working until those certifications are in place. So that's why that can be a little bit trickier for those particular types of businesses. But then the investors will know that, right? And so you tell the story around that, and that also is reflected on your financial projections.
Right. I agree that is a particular nuance to regulated markets. The place where I see companies maybe wanting to raise an extension instead of the next round is if they don't perfectly have product market fit, or they haven't figured out the sales and marketing engine yet. Those are typical times where it's like, hey, we have this one question we need to answer before we think we're ready to go do the Series A or the Series B. So let's raise a small extension, prove that out, and then our model will change, right? Our projections will become a lot more crystal. There'll be a lot more meat behind these assumptions, because we will have just done it for a few months, and therefore we'll have a higher valuation and a greater success rate when we raise whatever round. So I see that pretty regularly.
Yep.
Great. So just in terms of constructing your model, make sure your projections are capturing the size of the market, right? Hopefully you're attacking a big market. You better be attacking a big market if you're raising venture capital funding. So to the extent you're going to be generating revenue in the foreseeable future, you ought to have really big revenue numbers in the out years. Now, they can be too extreme, and I will talk about that later. This is a common place I see, is like even too extreme models, but numbers. But for the moment, like, just realize you're going to have to grow big, okay? And then work backward, sort of from where you need to be a big successful company. So it's easy if you're a software as a service company, because there's so many companies with SaaS models that have gone public. You can just look and see what they look like when they went public, right? And you're going to want to make sure that in a reasonable time frame, that's what you look like. Work your way back, okay? Because the venture capitalist wants to invest in a company that's on that sort of IPO pace. So figure out what that is and try to draw yourself into that. I obviously recommend working with an advisor like Kruze. We do this all the time, and we're pretty good at it. But if you're not working with an advisor, again, look and see what public companies in your space look like. The next idea is talk to other founders with similar business models who are a little bit ahead of you. We talked about this in the operating course. Founders generally like to share stuff. I mean, you got to be careful you're not talking to somebody who's too competitive, but it's a somewhat caring economy in Silicon Valley. There's definitely some sharp elbows, but people will talk with you and try to help you out if they like what you're doing, and they like you, and you're like a nice empathetic person.
Yep.
Great. So again, start from that revenue growth and other important KPIs and assumptions, and then kind of work backward from where you need to be. Thinking through these critical assumptions, like if you're software as a service company, thinking through your churn rate, your average pricing, things like that, right? If you have a sales team, how many deals can a salesperson close? Therefore, how many salespeople do you need? Therefore, what's your sales headcount expense, et cetera, et cetera. And don't forget that as your revenue is growing, your other expenses will grow as well. You have to start adding in HR, travel expenses will go up, R&D expenses will go up, server expenses, et cetera, et cetera. The place to spend the most time is in the headcount, particularly near term. That should be outputted from the operational plan work that you've done. And in the later years, again, talking to other founders or talking to advisors or seeing what public companies look like as they're at different revenue milestones in terms of headcount is sort of backtrack into that. Very common problem I see is companies not adding heads as they grow their revenue.
Yep.
That's ridiculous. You got to add bodies. It just happens. There's more stuff to do as you get bigger, more money, more problems, right? And then after you put that all together, kind of sanity check it. And now keep in mind, some investors will maybe discount the out years a little bit just to try to be a little conservative. So you don't need to discount too much as long as you're ending up with something that's kind of reasonable with those comparables that we talked about, the other companies in your space, other founders that you've talked to that you've seen raise money, companies that have gone public, what your advisors are saying. Like there's no, as long as you're kind of in that range, it's okay. Don't be too conservative. Don't model yourself out of a deal. If you're too conservative, then people won't think you're trying to grow big enough.
And so the good thing is about sense checking is that it isn't actually all that hard to do. You can think about the big topics that Healy just mentioned here, right? Staff, revenue, customers, and outgoings, right? And so all of these things just need to match up. So if you are claiming that you're adding 1,000 new customers, well, see if you have all the bits and pieces that you need. Do you have enough customer support? Do you have enough servers? Do you have enough all the pieces that you need for that, right? Where do these people come from? If you're adding 1,000, do you have enough marketing spend? Do you have enough people to support that? If you're looking to hire, do you have the right ideas about where these people are going to come from? Are you paying recruiters? All that kind of stuff. So just think about it from every angle and see if those things are reflected on the model. It's usually pretty quick. You can usually catch those obvious mistakes very easily yourself, but you have to sit down and actually look at the model from these different angles and just look at the same model again and again. But for, okay, now I'm thinking about staff. Does it make sense? Yes. Now I'm thinking about customers. Does it make sense? Yes. Oh, wait, actually, when I'm talking about this, there's something weird going on with the marketing spend. Then revisit that. It takes a couple of hours to do this properly, but it'll save you a lot of trouble later on because it means you can answer questions once they start getting thrown your way from the VCs.
Exactly. And you know what, that leads us really nicely into sharing the sample slide.
It's almost like we planned it.
We did. Good job. All right. So just as a reminder to folks that haven't seen the other courses, we have 2 free pitch deck templates that you can just get on kruzeconsulting.com/pitch-deck. The companies that we're showing here are just made up. We're not trying to actually pitch these companies. So the purpose of this is to show what should go on the slide and talk about the order and how they tell the story. I am looking in the 4 Ps one, which is a enterprise style sale company. And this financial assumption shows a lot of stuff that I was just talking about here, right? So, you can see we're showing KPIs like the total customers, and we're showing the average headcount, right? And then you've got the ARR and revenue. And I like to show both because they're like slightly different numbers, right? And that way the VC can do the math on the operating income and kind of get to the cash flow. We're showing how much cash that you're raising and sort of where your cash low points are. So now this slide is intended to set the table for the financial discussion, and you're proving to the VC that you're going big and you're ready to talk about the financial projections and how big you can get, et cetera, et cetera.
Yeah. And again, when I look at this, I'll be very honest, this is very not my forte. I see year 1, we're going to spend $6 million. Yeah, I feel good about that. I see year 5, we're going to spend almost $54 million. And I start to sweat a little bit. I'm like, okay, I'm going to be the CEO of a company I'm running a budget here with $54 million going out and, $50 million coming in at a 93% gross profit margin. I get palpitations from this kind of thing. And this is why it's such a good idea to work with people who do this kind of thing for a living and tell them, hey, Haya, these numbers aren't insane. This is actually pretty common. This is what we'll see. And, just to kind of talk me down a little bit. I'm so used to working in super early stage companies that years 1 and 2 look fine to me. And beyond that, I just get nervous. So right. Get the help you need because and actually, I've worked with Kruze on several of my previous companies, and these were the kind of models I got back every time. And it was really helpful to have somebody talk me through this, who has seen this work for other companies and who know what is happening at the fundraising stage, that these numbers aren't crazy, that this is actually a pretty solid way of looking into the future. Even though put a gun to my head and say, hey, what's your company going to look like 5 years from now? I just giggle at you because I'm like, yeah, sure. I have no idea.
So there are lots to unpack there. But first of all, thanks for the kind words about Kruze. I definitely appreciate that. But the key thing here is that this is a model that is being presented that shouldn't blow up your deal. Okay, there are a lot of reasons why someone doesn't want to invest in a startup. The financial projections shouldn't be one of them. This should be just not necessarily check the box, but it should advance the discussion in a way that is selling the business. It's selling the equity in the round that you're trying to raise, right? So this slide and the purpose of the model is to be strategic and to convince the VC to give you the money. It just is. And so you never want to not raise money because your model was messed up. That's really a silly reason not to raise. It's fine not to raise money because the VC doesn't believe in the market, or it's fine to not raise the money because the VC doesn't like you. That's a common reason, right? But don't have it be that the numbers weren't like put together nicely in the model. That doesn't make any sense.
Yep.
Perfect. All right, great. Well, we actually walked through this incredibly quickly, but let's jump to the common issues that we have that we see in the projections. And so the most common issues I see are either like too big or too small of projections, right? So too small, we've already talked about. If we're not trying to go really big, then why are you raising venture capital funding? You're not a fit. And then the too big is that I don't think that if you're going from 0 revenue to $1 billion revenue in your spreadsheet, you're worth any more money to a VC than if you say you're going from 0 to 100 million. Like in my experience, the VC does not provide any sort of valuation premium for that kind of crazier growth company. And in fact, they're less likely to do the deal because it's less realistic. That's my experience. And I have seen a lot of companies raise money. That's not to say you can't raise money if you're showing $1 billion in revenue from 0 in a few years, but most of the time that I see that, there's just something unrealistic in terms of how the founders are presenting the business, and the VCs don't like that in the founder.
Yeah. Well, and it's easy to understand why, right? If the founder doesn't have a firm grasp on the story they're telling there, they're just not believable founders. And, that is one of the big things that VCs look for.
Yeah, exactly. Now, the other major mistake I see is where founders don't add expenses on as they grow, right? So they have a spreadsheet that's got 3 employees in year 1, and in year 5, it still has 3 employees, but revenue's gone through the roof, or server costs haven't gone up, or they're not spending any money on recruiting, or to the extent they actually have a rent, they still have the same amount of rent. Like as you grow, you're unlocking more and more expenses. And this is where working with an advisor, talking to other founders, looking at public companies that have been successful with similar business models all helps you out. It helps you see how expenses grow over time as revenue grows.
Yeah. And as you already mentioned, headcount is typically your biggest expense, but headcount also gets more expensive, right? As your company gets better and bigger and all that kind of stuff, people expect fancier offices. People expect snacks. People expect, the office to be cleaned every day, that kind of stuff. And it's just, it's just a, like when you're a very early stage company and there's three of you sitting in a garage, right? That is a very different revenue model than having a nice office down in Soma in San Francisco. Right. And those expectations you have to build in, because at some point, you're not going to be able to hire people by giving them equity. The company has grown so much that you can't give significant chunks of equity to every single company. Well, it means you need to recompense in other ways. You need to get good healthcare. You need to get good perks, good comp package. That gets more expensive, and it needs to be in your model, because if it isn't, you fall into this exact trap.
Exactly. And another thing to think through is think about companies that have been very successful, and think about the first outside non-founder engineers that were hired, right? The first 40 engineers hired by Google. I don't know how much they made, but Google's paying like a ton of money now when they hire new engineers, and the cash comp is much higher now than it used to be, right? And so as you get more successful and bigger, sure, more people want to work for you, but that excitement around I'm going to work for peanuts to help grow this thing and I'm going to have a big equity stake, that starts to kind of become less of a thing, and it's more, hey, I have a great job right now, but I'm willing to come work for you for the same amount of money, and guess what? It's $300,000. So it just,
and that's an opportunity for you as an early stage startup, right? Because some of those engineers that have been doing this for 5 years have been making $350K a year. might have a little bit of a nest egg, which means they can now afford to work a little bit cheaper for more equity. So these are all like interesting pieces to think about when it comes to how you hire staff. But just remember that as your company matures, those dynamics shift significantly.
Yep, exactly. And again, your expenses should grow. Don't forget to grow your cost of goods sold. Don't forget to grow server costs, et cetera, all customer service. All those things are going to grow.
Yep.
A less common but mistake that I do see is forgetting that employee headcount is not just the salary, that there are benefits, there are payroll taxes. That's just got to gross up how much you're expecting to spend per employee, 20, 30, maybe even more percent, depending on where the person is located and what the benefit strategy is for the business. And then the final thing to think through that doesn't necessarily matter for every business, but it does matter more than you think, is working capital. And so basically this is the time it takes from a model perspective, like the sort of working capital is very complicated. I'm not going to define working capital, but the most common mistake around working capital I see is that there's often a lag between when you recognize your revenue and you collect the money. Mm-hmm. And so if you're a B2C company and you're charging folks through Apple Store, guess what? Apple doesn't pay you immediately. It takes 30 to 60 days before Apple sends you the money. So just keep that in mind, right? If you're selling to large enterprises, you might get paid up front, but it might take them 6 days to pay you, but then they might pay for the whole year. Well, suddenly you have a bunch of cash on your balance sheet. That's actually really helpful. So, it gets really complicated with companies that are doing hardware projects or have inventory. And it can also get complicated if you are expensing equipment that you're using for biotech research, et cetera, et cetera. It's not a bad idea to work with an advisor. Now, that being said, the VC is not going to decide not to invest in a Series A startup because their accounting treatment in year 4 for their equipment wasn't capitalized correctly. They just really care about the money, like the dollars flowing in and out more or less correctly, right? So don't over rotate on like accounting principles in the out years, and maybe not even in the near term years. Like just make sure you're getting the cash changes correct.
Yeah. And the important thing, and this is one of your big jobs as a CEO, is to not run out of cash, right? Mm-hmm. What we're really talking about here is, if I'm running a hardware startup and I need to run a batch of 200,000 units of something, that's a very significant chunk of cash. And that's only going to get sold gradually, right? That is really what you're talking about here.
Yep.
And so there's going to be a massive dip in my cash, and that's gradually going to build back up as I sell the widgets. That shows up in lots of different businesses if you hold stock, or if you have other ways that you actually turn cash into product and then product back into cash in various ways. If you run out of money, it's game over. That is the one way that your company will absolutely surefire end. And as the CEO, it's your job to make sure that that doesn't happen. If your financial projection doesn't show adequate padding there, then you're going to be in trouble. And I think it's one of those things that it's avoidable, right? There are ways around all this stuff, but the VC wants to know that you have a solid handle on this, so you don't end up stressing out about that when you ought to be working on improving the value of the business as the core business, not the amount of cash in the bank account.
So that does lead me to one other major common issue, which is too much detail.
Yeah.
Particularly the later stage investors have a team of sophisticated analysts who will dive into your model. They're going to click around, and you really don't want to have weirdly complicated formulas. You don't want to have obnoxious detail around sort of snack expense in year 2024. Like that is not a strategic use of anyone's time. And so remember, the purpose of this projections is you're selling, right? And you're telling your strategy through numbers. And so anything you put into the financial projections that you share with your potential VCs should drive that forward and shouldn't be bogged down on details. Now, it's very possible that you do have a much more detailed plan, particularly in the near term, about how much you're spending on snacks next month. Okay, but don't share that with the VC. They're going to look at it. They may ask you a question. It may derail the conversation. So you talk about Oreos for 20 minutes. Well, guess what? You got 30 minutes to talk with them about your model and sell your business, and 20 minutes is about Oreos. You failed. So keep the right level of detail.
Yeah. And that's really important for pretty much everything about this pitch, right? You can double click on dumb things like your product roadmap. You just don't know what's going to happen 5 years from now. So don't spend too much time, too much detail, exactly which features you're shipping then. That isn't helpful in terms of what this company is and is going to be.
Great. I agree. So let's just summarize it up here. Not every company is going to have the detailed financial protections in the meat of their presentation. Later stage companies need to have this. Sometimes it's okay in the appendix, but you want to make sure that you're setting the table for the discussion. Again, remember why the VC wants to see this. They want to see that you're growing big. They want to see like how much capital they're going to have as they invest in you. They're going to want to make sure you're big enough and good enough to raise your next round of funding. And then again, you're proving to them that you have a grasp about how your company scales and your strategy makes sense as you grow and you get it as a founder.
Yeah. And I think the final piece there is that in my experience, what often happens is that you have one meeting, everybody gets very excited and wants to talk to you more about your business. And then the second meeting, they might go very deep on the financials, or maybe the third meeting. And so when that happens, you typically send your model ahead so they can take a look and do some analysis and do some thinking about what they want to ask you about. And then you spend a whole meeting talking just about this one spreadsheet, where you can go pretty deep on how you see the business financially. And I'm actually looking forward to the episode we're going to do about how to build this model, because as I mentioned, it's not one of my strengths, and I'm excited to have one of the best of the business to pick your brain for a bit.
That's great. So again, we will have a course just around the Excel file that is attached with the operating plan that we shared. Again, it's my day job. I love talking about this stuff. And I think it'll be really helpful for you to see how the spreadsheet is built, but more importantly, understand the questions that VCs will ask as you dive through it and the strategy behind the numbers that you're putting in there. So great conversation today, Hai. Thank you so much for your time. Everyone, please go to kruzeconsulting.com/pitch-deck to follow along and to get the free templates. Thank you.
See y'all in the next one. Cheers.